right, well, good morning. So the downside of starting at 9 o'clock is that you're starting at 9 o'clock in the morning after there's been parties, but the upside is that the people who show up are interested and usually fairly knowledgeable to begin with, and that makes for a better experience for all of us. So the way that we decided to divide up the panel is that I'm going to talk about 280E and some current strategies that we're using to attack it that we developed for the Harborside tax case. And then I'm going to also spend some time talking about another case that we took to trial because we felt that it was a good one to set up an attack on the penalty phase against cannabis industries for not getting 280E correct. And we'll get into that in more of a detail when we get to it. It's the alternate case. Okay, so 280E says that no deduction shall be allowed in carrying on any trade or business if that trade or business consists of trafficking in controlled substances within the meaning of Schedule 1 and 2 of the CSA. Now, the first time the IRS used, let me give you a couple of minutes of history of 280E. 280E was passed in 1982 in response to a tax court case involving a drug trafficker in Minneapolis. He was a cocaine dealer. And even if you are engaged in an illegal business, there's still an affirmative obligation on you to file a tax return to report your illegal income and pay tax on it. And he said, okay, I will do that, but here are my expenses. And he listed all these expenses that a cocaine trafficker has, like cars and boats and bribes and everything else. And the IRS disallowed it. And he said, no, I'm going to take those deductions. And he went to tax court, and guess what? He won. The judge agreed with him. If you want him to report his income, you got to treat him like everybody else. Congress, the height of the war on drugs, decides that what they're going to do is they're going to pass 280E to address that issue. And so they passed 280E, and 280E lies dormant for many, many, many years. If you look at the case history of 280E, it's very rarely used. But then in the mid-2000s, the federal government was becoming very frustrated with the medical cannabis movement in San Francisco and their inability to slow us down. And somebody got the bright idea that, well, you know, the way that we got Al Capone was through taxes, so maybe that's how we're going to go after the dispensaries. So they went after a dispensary called CHAMP. And it stands for Californians Helping to Alleviate Medical Problems. And the lawyers that represented CHAMP came to me because I was doing a lot of criminal tax work at the time and asked me if I would agree to represent CHAMP, and I did. And when I took the case, I thought, well, you know, they're going to settle this because it's really ridiculous. They think that 280E disallows all expenses, including costs of goods sold, and went and sought to impose the tax on the gross profits, or the gross sales rather, not the profits, on the gross sales. Well, nobody could stay in business if you had to pay a 40% tax on your income and not be allowed to deduct any of your expenses. But I realized right away that, well, look, there's a fundamental error here because under the Constitution, they're at least entitled to take their costs of goods sold. But the IRS refused to bargain. And they told me at the settlement conference that we had two choices. We could either pay what they say was owed, or we could go to trial. Well, that's a no-brainer. It can't get any worse. So we went to trial. And the judge was Judge Lauro, a conservative judge, but he was fair, and that's all we should ever expect, is somebody who's going to treat us equally and be fair. And he said, well, what about this cost of goods sold that Wachowski says he's entitled to? And the service said, well, we think that 280E disallows cost of goods sold. And he said, well, you better think again, because I think he's right. Come back tomorrow and tell me what you want to do. So the next day they came back and they conceded that we were entitled to take cost of goods sold. Now that's a very important principle, because right there I thought, wow, we've won a lot of this case. He was nice enough to memorialize that in a footnote in Champ, so we never have to worry about that again. But then we moved to the language of 280E with respect to the expenses. And at that time I argued that this is not trafficking. This dispensary is licensed by the state of California, and therefore, since it's legitimate, it's not trafficking. Trafficking means an illegal business, and therefore 280E should not apply. Now he said that he thought that was a good idea. He wanted to research it, so he recessed for the rest of the day, came back the next day and said to me, well, I think I like your idea, but I've looked up the definition of trafficking, and while generally it's used to connote an illegal business, it's broad enough to include a legal business, so I'm going to find that 280E does apply to the cannabis dispensary. Okay, and then we went on and resolved that case very favorably, I think, for the industry, and we're off to the races. The IRS starts to audit more and more dispensaries, and we start to try more and more of the cases because we're being treated unfairly. And then, of course, they made the classic mistake of let's just go back to 280 so it's not too confusing, of auditing Harborside Health Center. Is anybody here doesn't know who Harborside Health Center is? It's Steve D'Angelo's. It's the largest dispensary in the country. And Harborside steps up to the plate regularly on behalf of the industry. They don't back away from a fight. They're a great client. They know it's going to cost money. They know they have a lot at stake. But it's the principle behind it. It's the activism that drives the dispensary. And they said, when they got audited, okay, Henry, here's your chance. Get rid of 280E. So one of the things that we did was, I still wanted to go back to the trafficking argument because I felt that trafficking, maybe the judge didn't fully understand or I didn't frame my argument correctly. And the example I was going to use is when I say around my kids that I'm going to go hook up with somebody, they say, oh God, you can't say that anymore. That means you're going to have sex with them. And I said, well, no, it just means we're going to get together. And they said, well, maybe 30 years ago, but not anymore. And that's when I realized that an argument that we could make is that the meaning of words changes over time. And that's what we have to go back and look at as to what trafficking meant when this was passed and put it in the proper context. So I persuaded Harborside to allow me to retain a linguist from the University of California who taught law and linguistics. And he and I went over 280E word for word. And what he decided was, or what we decided was, is that, hey, I shouldn't focus on trafficking, I should focus on consists of. And let me see if I have a slide on that. Okay. All right. What does consist of mean? If I told you that New York consists of Manhattan and the Bronx, you would say, no, you're wrong. New York consists of 5 boroughs. It includes Manhattan and the Bronx, but it consists of all 5 boroughs. Now, if you apply that appropriate use of the term consists of to 280E, what you see is that if a business includes the sale of cannabis, doesn't mean that it consists of the sale of cannabis. It consists of the sale of cannabis along with non-controlled substances such as apparel, books, papers, glassware, along with a variety of wellness services that are provided. And if Congress meant to have 280E applicable to any business that included the sale of cannabis, they could have said that. But what they said is that your business consists of. And we thought that this might be the Achilles heel to attack 280E. We had Judge Holmes was the trial judge. The trial in tax court went for about 3 days. And those of you who try cases in tax court know that most of the trials there are usually 2 to 4 hours. So we got a special setting, and he was a good judge, and we're currently waiting on the opinion. If we prevail in that argument, then 280E goes away. If we don't prevail in the argument, I still think it's going to be a good case for the industry, because one of the things that I've always stressed in each case that I've tried is the judge says, well, why do we have to spend time on this? And I say, look, if this was a bakery, we could go to the IRS books and records and see that you set certain parameters. You know our cost of goods sold are going to be somewhere between 50 and 60% of our gross sales, that our expenses for this are going to be within this parameter, our expenses for that are going to be within that parameter. Although we have approached the IRS on multiple occasions and asked them to sit down with us and try to figure out parameters that we could apply to dispensaries, they have refused to do it. So, being activists, what we decided to do is if the IRS won't do it, we're going to have the tax court judges do it. And we take more and more cases to trial so that they will set the parameters. So even if we don't prevail on this argument in the Harborside case, I think that what the judge is going to do is memorialize a formula that we can all look at going forward and understand and work with in addressing our tax obligations. All right, now the next case that I want to spend some time talking about is the Alterman case. Laurel Alterman is a 70-plus-year-old cancer survivor who, after she survived cancer and received much benefit from her use of cannabis during her treatment, she opened up a dispensary here in Louisville, Colorado, a little bit outside of Boulder. And of course, she got audited, and the IRS, in my opinion, treats every audit against the dispensary very aggressively. We had the usual issues that you see in every tax case. They always accept your gross sales, by the way. They never question you. But then they want you to substantiate your cost of goods sold. And then they want to disallow all your expenses because you're trafficking. Even though CHAMP established the position that we're entitled to an allocation, the service has regularly been ignoring that, relying on, I think, a misinterpretation of the Olive case. The attorney from the IRS who spoke yesterday talked a little bit about Olive. It was an unfortunate case. He got bad legal advice. And he did nothing but sell cannabis. And the judge said, well, all you do is sell cannabis, then 280E applies, and I'm going to disallow your expenses. Alterman did more than just sell cannabis, so she was entitled to an allocation. So we argued about the allocation. We argued about the substantiation as to whether or not it was adequate. But I felt that Alterman was a great case to attack the imposition of a penalty for an understatement of tax. So, for those of you who aren't tax lawyers or involved in this area of the business, essentially, if your tax return is wrong and you lose in tax court, the IRS has an option of imposing a negligence penalty, or a substantial understatement penalty, or a fraud penalty. And in every audit that we've been involved in, they have initially imposed a penalty because they say that we didn't properly handle 280E. What we did with Alterman was we had her testify at the trial. This wonderful 70-year-old woman gets up and she says, I won't go over the back and forth with the questioning, but she said to the judge, because it's a court trial, she said, look, I knew I didn't know what I was doing. I went to a lawyer that told me he specialized in being a cannabis lawyer, and I did everything he told me. This is how I prepared my returns. And he directed me to an accountant. And the accountant told me that he prepared returns for many dispensaries and knew what he was doing, and he prepared my return. They gave it to me, it looked good to me, I signed it, I filed it. What more could I have done in good faith to get my tax return done correctly? And you could see the judge was just taking this in. And I mean, it really is unfair when somebody tries to do it right, especially in an area where there is no agreement. To impose a penalty would just be, in my opinion at least, unconscionable. So we don't have a decision yet in Alderman, but I'm very confident that that one will be, should result in striking down or giving us a lot more to work with respect to the imposition of penalties. Presently, we have 3 cases that are pending in tax court that are awaiting decision. Alderman, which we just discussed, Harborside, and then there's another one called LA Patients. That one was tried in December. One of the things that are going on in the tax court is that the judges are starting to realize that we are going to try the 280E cases and that it's an issue that needs to be addressed. And so I think that they've decided to put everything on hold until Holmes issues his opinion in the Harborside case. Routinely, they've been granting extensions for cases to go to trial, and you should, if you're involved in any, you should definitely ask for an extension. Just make sure you explain to your client that the only penalty they have, or the only detriment of seeking an extension is to the extent that they owe any taxes, that the interest is going to continue to accrue. But it would be unfortunate to take the case to trial and then have Harborside change all the rules, and you might not get the same result. I do believe that Harborside will result in a lot more clarity on how to move forward. And you know, the good thing about Harborside is their general counsel is here, but he won't object, I hope. But if we don't get the decision we want from the tax court, we're going to go to the Ninth Circuit. We're not going to give up until we address this issue to our satisfaction. It's wrong, it's unfair, and we're going to keep fighting. So thank you.
Good morning, Jennifer Benda with Fox Rothschild. I haven't been doing this nearly as long as Henry, and I think he teed things up nicely. And what I'm going to cover is the next step. If 280E applies, and if we have to deal with that, how do we help our clients determine what cost of goods sold is? And that's kind of how I came to represent these clients. I got a referral one day from a CPA who said, someone needs an attorney who can help with a controversy involving 263 Cap A. And I thought, well, who is going to litigate that issue? And then when I got the phone call, I realized it was a cannabis company. And interestingly enough, I have a background in accounting and worked as a CPA for 10 years before I graduated from law school, and wrote a paper on 263 Cap A when I was getting my master's in accounting. And so the initial call with the potential client was a conversation where I was rattling off about 263 Cap A. I'd been in Denver for a few years, and I was following the issue just from an intellectual standpoint. And it was about a 10-minute conversation, and I had my first client in the industry. And it's been an interesting ride. It's interesting working with the accountants who are preparing these tax returns and talking to them about how we go about this. So I have 280E again here for you, but we'll jump right into what guidance has the IRS given us on how we determine cost of goods sold for these clients. And there's a CCA from 2015 that talks about the IRS position that 263 Cap A doesn't apply. Now, I'm going to see your eyes glaze over in a few minutes because I'm going to get into some inventory accounting discussion, but I'm going to try to hit it on a level and be as basic as possible so that you can try to highlight for your clients what the real issues are. But the IRS has taken the position that the rules that we have to apply are under 471, which is inventory accounting rules that have existed since the 70s. And in 1986, which is after 280E was passed, the IRS decided that taxpayers were not capitalizing enough into their cost of goods sold. And they passed 263 Cap A. What 263 Cap A says is you have to put more costs in cost of goods sold, and it really focuses on overhead. So your HR department and your accounting department and departments like that, and how do you allocate that between your production activities and your sale activities? So generally, taxpayers don't want to put more of their costs in cost of goods sold, but here we do. And the IRS is generally litigating the other side of this issue, and here we want to take all that law and help the industry. So that's where I'm focused. And the theme I have for you is 471 is broad and generally favors capitalization. So the discussion I have with a lot of my clients when it comes to 263 Cap A is, I don't necessarily agree with the IRS position if I think someone's going to wind up litigating that issue, but 471 is broad enough that it gets us materially close to 263 Cap A. I think that's an interesting way to kind of work through the issue with the IRS. We're applying 471. 471 lets us do this. And I think that's the position people need to focus on. And it gets us to this accounting world that most lawyers don't want to get too in the weeds on. But it gets you to cost accounting and inventory accounting. And what you need to be sure that your clients are doing is hiring experts, accounting experts who know cost accounting, who are good at cost accounting, who can dig into the numbers and help us maximize the cost of goods sold under all the methods that are available, because there are many, many of them. And the method that you want depends on the way these businesses are set up, which we're learning is varied from state to state. In Colorado, historically, we have had to have grows and retails in the same business. Other states are set up completely differently so that grows are independent from the retail. So the way we attack these issues are very different. An interesting tidbit that I always like to bring up, one of my clients raised this with me one day, which is there's a memo out there in 1996 when the states started moving towards legalization, and they talk about all the strategies they're going to use to try to fight against legalization. And one of them is the IRS is going to continue to implement the tax laws. And they knew this was a hammer that they had. And I think what we're seeing right now, and Henry would probably agree, is that that's as much as the IRS will say we're not trying to be unfair, I think my clients feel like they're being attacked.
There's no question that the two biggest challenges facing the industry are taxation and banking.
I agree. So it is interesting to see that this is out there as part of the policy of the federal government, and I think that's where they're coming from. So what's the legal problem that we're dealing with? As Henry mentioned, the IRS, the way our income tax system works is there's a constitutional limitation on what can be taxed. So we can't have a gross receipts tax. And what they have to do is when you sell an item, it has basis. You had to buy it, you had to buy your house and you sell it, and what you paid for it is deducted from the sales price before you can determine the income that you're potentially taxed on. All these expenses that the IRS disallows under 280E are the other expenses that the code says these are additional expenses that you can take in determining your income tax. So what we're dealing with is what is part of our cost of creating this product versus what is a deduction? What are these other items that we spend money on to keep our business going? And I'm going to go through these somewhat quickly, but there is a fair amount of law to cite to, starting with section 61A3. You have to be able to sell a product for more than what you paid to create it before you really have any gross income. And as I stated earlier, a marijuana business is going to be encouraged to capitalize as many costs as possible in determining what their inventory costs are. Here in Colorado, all our clients pretty much have grows, and so I think you have a lot more expenses to look at and consider in determining what can go into your cost of goods sold. And when we start looking at some of the cases in this area, we do see that there's support for this notion that cost of goods sold is very hard to determine. And I actually think that gives us a little bit of latitude and wiggle room. And that's the way I'm trying to approach these cases. And when the IRS has tried to argue that cost of goods sold should be limited, they've not had as much success. And there are some cases in here that will help you deal with that issue, but I actually think this is a lot like valuation cases, which is there's a range. There's kind of a range where people are gonna maybe be able to agree as to what valuation is, and it's not precise. And I've had interesting conversations with some agents who are really digging in on this issue. And we talk about how far we can go in determining all these other G&A expenses and overhead expenses that can be allocated to cost of goods sold. And I had an agent actually say to me that he read an industry paper, and I can't remember if it was the candy industry or the cigarette industry. He's doing all this research as to how other industries might be determining what cost of goods sold is. And he said that most industries, there's kind of this notion that there are all these other costs that we could attribute to cost of goods sold, but nobody wants to go through the trouble of tracking them all down. And I think that's an interesting point, because for most taxpayers, it's a timing issue. For us, it's a permanent difference, which increases our tax liability and makes it harder to make money. So I think people are having to dig in at this point. I think another interesting thing about 280E is every other illegal industry gets to deduct their ordinary and necessary business expenses. And this really is a highly unusual situation.
Well, in medical states, I thought of making the argument that it's discrimination based on an illness.
Right. It's interesting.
If we don't win on consists of, maybe that'll be the next meeting.
So I think it's interesting in talking to clients to kind of, I want to keep this as practical as possible and not drill down too much in the accounting, because I know how uninteresting that is for a lot of people who aren't nerds like me. But clients have this notion that they need to increase cost of goods sold, and that will decrease their 280E impact. And that's a little bit inaccurate. The only way you reduce the impact of 280E is by reducing your retail selling costs. And increasing your cost of goods sold doesn't necessarily do that. There's not a direct correlation unless the expense that you're talking about is actually one that you can carve out of retail. So if it is one of these overhead expenses that can be allocated somehow to the production side of your business. So I have a lot of discussions with people about this. They just think, oh, we just need to increase our cost of goods sold, and if we increase our cost of goods sold, that's going to reduce the impact of 280E.
Yeah, well, if you increase your costs, then you just reduce your profit. What they really want to do is allocate or reallocate what their accountant thought was an ordinary expense to a cost of goods sold.
Right.
Like if you package the product, well, that's a cost of goods sold. But most
Not according
accountants...
to the IRS.
Well, yeah, they're like a recalcitrant child. I mean, basically, you can fight all day long with them. It's just like that paper you were talking about that addressed the 263A. They say that this is the position. Well, you know what? It's the IRS position. No tax court has ever found that that's accurate.
That's right.
And so challenge it every
Right.
time.
I
Well,
have
that's
a
your
footnote that I
interpretation.
drop into everything that says, you know, we don't agree with this, but for now, let's talk about 471 and see if we can work
Yeah,
this out,
that-
you know?
it's get to get you the same place.
Right, if I can get it close enough and save my client the pain and heartache of litigation, that's what I wanna do. So, I've got quotes here that talk about, just to give you a little bit more legal resources available, there's this notion of direct costs and indirect costs that are very important in inventory accounting. Direct costs, that's obviously the seeds, the water, the lights, everything that kind of physically becomes part of the product, the people that are planting them. Then there's this notion of indirect costs, and I don't think I have my usual slide on this, but we're talking about rents and other expenses that are related to the manufacture of the product. And I'm actually seeing in some of my audits that the IRS is saying you only get direct costs. And I talked to Matt Houston about this after his presentation yesterday. And he's like, nope, that's, you know, there are agents out there who are not following the regs, who are not following CCA, their own national office advice. And that's where I'm finding I have to push back a lot right now. And it's gonna be a long fight, because I don't see them backing off anytime soon. And I think this last one I'll kind of leave you with, and we wanna be sure we have enough time for questions, is, you know, this notion is very hard to determine what cost of goods sold is. And there's even a case that tells us that. In a manufacturing operation, cost of goods sold is more difficult to determine since items necessary to produce a saleable article is distinguished from other ordinary necessary expenses may not be easily ascertainable. And that's kind of the theme that I like to use in talking to the IRS, dealing with all this stuff, trying to get them to at least reasonably address some of these allocations. And make sure and I'll just leave you with this few accounting notions to deal with. In inventory accounting, it's very important to get on the right method. And if you don't get on the right method, you have to go ask the IRS for permission to change your method. And I can see the IRS easily denying cannabis businesses a change to a more favorable method. Would you agree?
They are not our friends.
So I think that addressing this inventory accounting issue and being sure you get the right people in place to really help you get on the right method is an important issue. Because once you file 2 tax returns using the same method, you're going to be on a method, you're going to have to go ask for permission to change. And that might not be easy to do. So any questions? We have some slides on the challenges to 280E, but since Matt covered that yesterday, I figured we'd just focus on any questions you have.
Actually, though, I would like to make one comment. We've been sort of digging in at the IRS, and I should say that in the national office and the people that are making policy, they're not particularly friendly to cannabis. But one of the things that I've seen over the years in doing the audits for the dispensaries is we're starting to see a real difference in the agents that are doing the audits. Because there are some agents out there that still consider this to be a gateway drug, but then there's more and more of them who had experience either personally or through a family member who's had a medical issue that has received real benefit from the use of cannabis, and those people start to treat us really well. And we used to get some of those people to give us pretty good deals in terms of settling, but one of the things the service did was they actually formed an office in the national office that now reviews all the cannabis settlements to try to prevent us from getting some favorable ones from sympathetic agents.
Well, and there was So I've only been representing these clients for 2 years, and in Colorado, what happened, my understanding is, this is all kind of hearsay, is that there was someone at IRS speaking at one of these panels or forums who said, you need to use the square footage allocation. And the square footage allocation was basically, you look at your store and everything except the actual sales counter is related to your cost of goods sold, because you get to accumulate all this cost until the moment that somebody walks up to the counter to make a purchase. And that methodology was used and passed muster in some of these audits, and the IRS is nowhere close to accepting that methodology now.
I think it's a little bit more nuanced than that. I think that what happened is one of the arguments that we made in the Champ case after we addressed the COGS issue, the cost of goods sold issue, was that they were entitled to an allocation of their expenses under 280E because some of what they were doing was non-trafficking. It didn't involve a controlled substance. And the service said, absolutely not, blah, blah, blah. The judge said to us, what's your position? And I used the cost accounting example. I said, well, look, if the cannabis counter were the perfume counter at Macy's and it took up 15% of the floor space, then you would allocate 15% of your general overhead expenses to the perfume counter and 85% to everything else. So now, using that example, let's go to Champ. And Champ, the cannabis area of the enterprise, took up 15% of the overall floor space, and therefore we argued that 15% of their general overhead expenses should be allocated. And the judge agreed with us. That's why at the beginning of the trial, they went in and they were seeking $500,000 in back taxes. At the end of the trial, they got $4,900, 1% of what they were alleging. Now, what happened was that some people took that square footage allocation and came up with what was called the transactional analysis. And what they would do is they would time the amount of time with a stopwatch that it took to do a sale. And it took about 2 minutes to actually consummate the sale. So they argued 98% of the time, it was non-trafficking, and that got a little too aggressive, and the service stopped that. Okay, but I think that the square footage analysis, in and of itself, does still have some viability.
It's appropriate for certain factors. If you're allocating rent and part of your store is, packaging of inventory. Would you agree with that?
Well, that gets a little bit more sophisticated, because basically we do two things when we go in and set people up. Is we look at the square footage and how it's used, but then we also help them craft employee job descriptions.
Right.
Because if an employee spends 30% of his or her time packaging the product, if you get the product raw, and they package it, then that 30% of what they get paid is the cost of goods sold. And if they work on the retail, should be, no, you always go in. We're right, you're wrong, convince us, you just don't understand the law. That's been effective.
Right.
It just takes a lot of time and effort, but believe me, if you get audited and you get set up right in the beginning, you'll save money in the end. And I think it's probably pretty fair to say, and you tell me what you think, but if you're in the cannabis business in California, it's not a question of if you're going to be audited, it's a question of when will you be audited.
Yeah, my clients say everybody's under exam here in Colorado. And they have a team of people that are dedicated. This is all they do is cannabis audits. And that's what we're dealing with.
Well, so do we. And we're just as dedicated.
I think, Matt, there were two things about Matt's presentation yesterday that I thought were interesting. The notion, the separate trader business notion. So he talked about Olive and Canacare, and I think part of the issues with those cases in establishing what is the non-trafficking part of the business was just a lack of the really good books and records. And I would say here in Colorado, we have exceptional records for most of the clients that I have, and it's very easy to identify what our non-cannabis trader business is, what the gross receipts are attributable to that business, and definitely want to make arguments that we get the ordinary necessary business expenses related to non-cannabis sales. I think he pretty much acknowledged that's a good position.
Have you seen where the IRS will impose the Hobby Lobby Rule 183 for the allocation, if you get too aggressive on the allocation of indirect costs to the non-cannabis activity?
I've heard of that, I have not seen it. And I think, does that issue come up more with the nonprofits? Because we don't have the nonprofit model here in
Yeah,
Colorado.
we don't hear, but
Okay.
I resigned from that client when that issue came up. It wasn't my client, but I was asked to handle that IRS exam
Right,
because they had adopted a method of their allocation between the cannabis and non-cannabis activity. They had very heavily weighted their 162 expenses to the non-cannabis side. They created a loss on their non-cannabis side. They're going to lose that issue.
I
They might
think
have
I
been
would
too
agree.
aggressive.
Yeah.
I think
I don't
they're-
know
I
how
think
you
they're-
can allocate it other than percentage of sales. I mean,
There's a guy in town that's very aggressive on it.
Okay.
So,
yeah. People are getting very creative, so.
Where do security costs fall? Are they allocatable, or
You mean like the security guards or?
the guards,
going public?
the whole bit, you know?
Where
that's-
are they? Are they at the grower and store?
Well, let's assume they're at the store. The store is where all the liability is, all the potential
Right.
exposure is, right?
Right.
Well, I don't know about that.
No.
but Some guys I've seen have potential exposure. Well, okay, so the way that we handle that is we do an allocation. And to the extent that we figure that the security guard is there for securing the inventory and making sure nothing happens to the inventory, then I consider that to be a cost of goods sold. To the extent that they're there for retail, then that would be a 280E expense that's disallowed. But also, in Colorado, are you required to have security guards?
I don't know, but there are security cameras that are required, a very, extensive camera systems, and the IRS tells me that that's a compliance cost that can't be included in cost of goods sold, so that's something we're dealing with.
That was my question. In Oregon, I actually was just at a presentation, a pitch event, and there was a security company out of Oregon that they do have the requirement for the video cameras in every single inch of the space. So
Right.
if you have like a little cutout, it requires an additional security camera. So I was wondering if it's required, does that make it better or worse for this deduction? But it somehow comes under this.
Well, the IRS position is that's a compliance cost. I think you still argue that it's a part of your creation of your cost of goods sold. You have to protect it and comply with the law.
Absolutely. Don't let them lay out the playing field. I mean, my argument would be, yes, the state requires it, but because I'm also selling T-shirts and books, and I want to sell them here, if the state requires me to have a camera, that's a cost of doing business. I mean, the worst that'll happen is that you'll either settle it or you can go to tax court if there's enough at stake there, but I would never concede the
Do
issue.
you think a judge is going to walk through expense by expense and give us a
No,
detailed
they'll tell you to go out and settle
Yeah,
it. Okay,
yeah.
and
So I
so
think
then
when
you're
it gets
better
to that
off. If
point-
the IRS doesn't settle it, the judge tells it to settle it, wow, you see a big change in attitude.
So I have a comment and an ask on this. One is, the AICPA is not going to help us here, I don't think. But I think it would be really helpful for the entire industry, for you, Henry, and a bunch of CPAs to get together and actually write some white papers that,
I'm working on that,
inventory
yeah.
accounting, et cetera, so that we start establishing, the wine industry's got standards, the candy industry's got standards. Most of the time, the AICPA has done that. They're not going to help us here because they're too afraid still. But I think it would be really helpful for the industry so that there's some broad guidelines of what's acceptable and what's not acceptable in inventory accounting. So at least we've got something to wave in front of the IRS's face. And this whole idea, just so you all know, I'm from Woodwell. The IRS has taken the position in some of these cases that the cost of your license, your OPC license to grow cannabis is not a legitimate part of your cost of goods sold.
You just have to associate that back to the inventory.
Well, they're the most insane positions that could possibly be taken. And at some point, if we've got enough industry standardization, we may find ourselves in a situation where we can start asking the IRS for fees. And I mean, we have to get to the point where we can actually start winning some of these cases and start embarrassing some of these agents. Otherwise, they're gonna keep doing what they're doing. And that's why I think some sort of industry papers, whether it's from this organization or some, cannabis accounting organization or something, where the broad parameters, what's appropriate accounting method and what's outside the boundaries would be really helpful for everybody.
Yeah, one of the issues we've dealt with is just what I call tax return confusion and the way tax returns have been prepared and what lines are filled out, what lines aren't filled out. And people come to me and say, I don't understand why I got audited, and I look at page 1 and I'm like, well, it's pretty obvious to me. So I do think that as there are more sophisticated accounting firms, especially with things opening up out east, that are more interested and less afraid to start representing these clients. And those are the firms that I'm talking to about this notion that Dean has raised, which is let's try to get, guidelines for the industry as to, so that all the accountants who are out there trying to do this work are at least trying to follow the same set of rules or be some sort of consistency. Sorry, I'm not ignoring you. Go ahead.
So the AICPA doesn't have any rules, but are there any accounting industry standards in Europe that would at least be persuasive?
I don't know, but one of the things we can look at is similar industries. So we often talk about, agricultural rules, wine industry rules.
Tobacco.
One of the agents, there are things there, and I've talked to people who represent those industries on inventory accounting issues. And we are kind of exploring that. I don't know if there would be any cannabis-specific rules in Europe, but we do look at similar industries, and we just don't have a history here where these things have been developed, but they need to be.
But part of the problem lies in that the majority of the tax returns for the cannabis industry, at least from what I've seen so far, are prepared by public accountants, not certified public accountants.
Mm-hmm.
And very deep in the regulations, and I believe it's under 471-11, is a sentence that says if you keep your accounting records on a GAAP basis, generally accepted accounting principles, you can enlarge those expenses that can be treated as inventoriable costs. And PAs don't understand GAAP.
Well, part of the issue we have with that specific part of the regulations, which the IRS is actually very focused on, they want to use GAAP methodology to determine cost of goods sold, is that nobody has their books on GAAP.
Our clients do.
And I argue that we don't have, we don't have GAAP financial statements. We have books and records, and we have to determine for tax purposes what cost of goods sold is. So, but that provision, so I spoke to one of the attorneys that was involved in drafting this part of the 471 regs. And the purpose behind that provision is that there were a lot of industries that threw their hands in the air and were like, you're going to make us do 2 sets of books. And they thought that allowing people who were using GAAP methods to use those methods for tax was reasonable at the time the regs were drafted.
But those are the rules.
Right. Right. I'm not saying the IRS is following all these 471 rules. We're just kind of pointing out what they are. And the 471 regs are kind of exactly where you should focus. So when I talked to Matt yesterday, that was part of his presentation that he didn't make it through. But if you read those regulations, they list many, many expenses that are indirect expenses that are required to be included in cost of goods sold. Yeah.
Do we have any estimates of the nationwide impact to the Department of Treasury that is positive cash flow for their tax coffers as a result of 280E? Like, what's the total Department of Treasury inflow that they're defending?
Quite a bit.
I think that depends on whether the tax returns being filed, if there was any attempt to apply 280E or not. I think a lot of the industry is not even, they're just playing the audit lottery and not, so the people who, I make the argument, if my client has a 280E disallowance on their return, please leave them alone and go attack the people who.
How successful was that strategy?
They roll their eyes, but I'm not gonna stop saying it.
Okay, all right, we got a
Anyone
1 minute
else?
warning, so thank you very much for coming, for getting up so early, I hope you got some.